So we're coming to the end of 2020. I'm starting to think about what's up for 2021. I'm kind of excited that we seem to be heading into a recovery, but at the same time, I'm concerned about the high prices that we're seeing right now, and I'm worried about the potential for a crash in 2021. Let me tell you my thoughts. You have to pay attention to your money. So right up, if we start thinking about what's going to happen next year, especially if we're worried about a potential crash or a new bear market, I think we need to think about what's happened in some of these previous crashes. Now, I can tell you, I've lived through 3 previous crashes in my investing career. So what's the potential for a market crash in 2021? Well, if we look at those 3 previous crashes that I mentioned having invested through, I was through the dot-com bubble meltdown in 2000. I was invested during the 2008 financial crisis, and I've lived through actually several of these technical flash crashes in the recent few years. So I have some firsthand experience at what happens with these things and how to try to stay invested and ride out the damage. Was 2020 a bear market? There's actually a little bit of speculation that maybe it wasn't, just due to the sheer speed. So I want to touch on that and explain why, in fact, that time it was just a little bit different. I also want to talk about the business cycle. And for those that don't know, there's this theory in economics that there is this boom and bust cycle in the underlying economy that tends to drive the stock market and vice versa. It has, or it seems to have, less of an effect these days than it had in decades previous. And I want to talk about what could be behind that and what it might mean for the future. A big part of that story, too, has to do with inflation and why it's not what it used to be either. And finally, I want to talk about 2021, look into the future a little bit. And just like everybody that makes these predictions, I'm going to tell you why in 2021 it could be different this time. So what about those previous crashes? Well, I lived through the dot-com bubble. In fact, I worked in technology during that time, and I worked for and with a lot of the companies that had these absolutely crazy business models. Looking back on it now, I can't believe that some of them got the amount of venture capital they had for these paper-thin business ideas that were completely harebrained schemes at the best. And so the fact that there was this amount of irrational exuberance, as Greenspan said at the time, driving the stock prices of these things, it inevitably led to a crash when that bubble burst. There was no connection to fundamentals at the time when the underlying businesses, and afterwards there was a real economic impact. It wasn't just tech companies that suffered from that. There was a lot of follow-on businesses that also had a lot of pain, and a lot of folks were significantly impacted in terms of the amount of wealth they were able to build investing in the market during that time and immediately afterwards. So the 2008 financial crisis was different again. It was very much driven by and rooted in the financial markets and the complexities of how they worked. It had to do, of course, with these subprime mortgages, which led to a liquidity crunch. Things came to a screeching halt. It was made worse by these derivatives traders that really didn't know what they were doing, or at least the people who were really in charge of the money at these large trading firms didn't quite know what they were doing. It made the whole thing even messier, even more painful. And it really took a long time both to complete the crash, to actually find a bottom, and then to actually recover. So that one was very prolonged, unlike what we just saw in 2020. I think that's a key difference. These flash crashes have happened in 2010, 2011. There was one in 2015. And at the time, these were really alarming to people like myself that were investing through those years, because they were very close in terms of time to the pain we had lived through in 2008 and back in 2000. And when we saw these sudden sharp dips, number one, it was completely inexplicable at the time as to what was going on. And number two, it felt like we were absolutely heading right back to where we were in 2008. There was a lot of panic, there was a lot of fear, and people didn't quite understand what was up. In hindsight, I think the analysis now points back to the rise of computerized trading. These algorithms that were taking over from humans at the time, inevitably they were early stage, and so they had errors, they had bugs, they had software defects that led to these unexpected consequences and caused these incredibly fast plunges in market value. So why was 2020 different? Well, primarily we did meet Primarily, I should say, it's because we did meet the technical definition of a bear market with a 20% decline from peak to trough. That did happen, but it happened so quickly and the recovery was so fast that you almost have to wonder if it in fact counts as a bear market. A lot of people are claiming that it may not, and this may actually now be a continuation of the bull market that's been happening ever since the financial crisis. I think it's important too to call attention to the fact that in 2020, this was not due to anything that was connected to the fundamentals underlying the economy. The other thing that's at question here is what sort of recovery are we now coming out of? Is it really a V-shape or is it more of a K-shaped recovery? And I want to touch more on that in a sec. Now, in terms of the speed of recovery, it was completely unprecedented. You can see here the average number of days from the bottom to recovery. The previous peak was 1,500 and some days. The shortest prior to that was 310. We did it this time in 126 days, which completely blows any other recovery out of the water. And really, it's because of that outside shock and the speed at which we were able to remedy the underlying cause of that outside shock in terms of the vaccine and the potential recovery that we now see on the horizon. Nothing like that's ever happened before. So back to that V or K-shaped recovery. So a V-shaped recovery is what we see on the chart, but a lot of people are pointing to the underlying economy experiencing more of a K-shaped recovery. And so it has to do with this phenomenon of folks that are able to work from home are typically professionals. They typically tend to be white-collar workers, and they are not only were they not terribly impacted by the overall economic effects of the pandemic shock, but they're actually able to get back to work much more quickly, and they are actually able to save money during these times when they can't spend what they used to spend. And so that increased saving is allowing them to make increased investments, and they're actually getting wealthier over time. We see this in terms of the housing market and the money that's being driven into new home sales. On the bottom side of this, though, you have folks that don't have the luxury of working from home. These are people that actually need to go out into the real world and do a physical job at a physical place. These folks are being hit much harder by this. It's taken them a lot longer to recover. In fact, they're not in a recovery yet. And the ongoing impact of this into 2021 is going to keep having these folks feel the pinch and having them rely on that stimulus money. That is going to lead to more unemployment. And so the unemployment numbers are already incredibly high. Yes, they're recovering a bit, but as we head into the winter here and we see additional lockdowns, the fear is that in the bottom of that K, in terms of the K-shaped recovery, these folks are actually heading towards a sustained unemployment problem. So in the past, there was a very clear connection between the business cycle and the actual stock market. What would happen was there would be this continual expansion, reach a peak, go down into a trough, and then recover. And these expansion and contraction cycles were primarily driven by the interplay of inflation rates and then interest rates that central bankers would set in response to this. And it was almost like steering an icebreaker through the Arctic. You would turn the steering wheel and 6 months to 9 months later, you would know if something actually happened. At these earlier stages in the business cycle decades ago, it was very, very difficult for central bankers to be able to respond to these. And so more than today, it created quite a bit of swing in these business cycles, which contributed to the overall slower swings of the broad stock market. But now, the central banks have a lot more tools at their disposal. The financial markets are more sophisticated. They are controlled by all kinds of additional layers of policy sophistication that makes it a lot easier for central bankers to do what they need to do to correct these inflationary or deflationary pressures. They have so many more tools at their disposal now with quantitative easing, the ability to print helicopter money, as they say, that their support for the markets is completely unprecedented in history. So the way it used to work is that this up and down in terms of the business cycle will be moderated by higher wages and higher prices. So in a tight labor market, folks are able to demand bigger raises, then they make more money. When they make more money, they're able to spend more, and that contributes to a rise in prices. These pressures, though, don't work the same anymore. Today, it works now more like this. With the response to the business cycle has more to do with outsourcing and automation. And what I mean by that is instead of workers being able to demand higher wages and companies being forced to pay them, they're able to respond with different ways by increasing automation and by outsourcing jobs. And really, this is also a problem in terms of the value for money issue because technology is keeping inflation low. The pace of technological innovation has never been higher than it is now, and it's driving additional value into our lives in the form of gadgets, phones, medical technologies, all kinds of things that are costing less than they ever have before. We get way more for our money these days because of technology. Given all that, what does it mean for 2021? I think in 2021, we may see additional lockdowns in the early part of the year. And to the extent that that happens, I think that raises that problem of unemployment. That's a concern. I think the presence or the absence of additional stimulus in these different countries around the world is another make or break situation for the early stages of 2021. If that stimulus gets out the door, then I think it has the potential to support the economy through that period. The risk is that that stimulus, to my mind, will be undershot in some markets, and it will prolong this unemployment problem. The other potential concern I see heading into next year is the idea that we may be looking at a housing bubble. Home prices have risen incredibly quickly, and I think although we're not in bubble territory yet in Canada or the US, I think we're close. The market is overheated because of perennially low interest rates. I don't think that interest rates are going to rise until 2024. And so from now until then, we're going to have a ton of cheap money driving home prices and keeping them going. If they get too high too fast, we could absolutely be at risk of a bubble. And the big risk I see from a housing bubble is the inevitable contribution that will make to high unemployment. You see the theme here? Now, on the upside, what could eliminate that risk? I think at the end of the day, businesses are going to recover once a vaccine gets us back to normal. I think that there's a lot of talk about jobs being lost forever, businesses being driven to the point of extinction where they can't just reopen. I think that's true. I think a lot of businesses will probably never come back, but I think that into 2021 and 2022, you're going to see those businesses that have died be replaced by new businesses. At the end of the day, it's supply and demand. As the demand side recovers, folks are able to go out again, spend money, travel, consume services, all these things, then there will be a market opportunity that entrepreneurial people will step up, they will create new businesses, and they will meet that demand. That's just how the economy works, and there's no reason to believe that it's not going to work in 2021. In fact, I think we'll see growth like never before, based on this fact that there is a void of services, but there is not a void of demand for those services. So I think the potential to start new businesses to meet that demand is huge, and a lot of people are going to take advantage of it next year. And the other thing I think we have to look forward to in 2021 is that the bad news is priced in. The market is very, very forward-looking, and the prices that are reflected in the market today are already taking into account the known timelines for a vaccine, the known timelines for unemployment recovery. There are a few variables left in terms of stimulus timing and things like that, but for the most part, the bad news is already priced in. And really, when you think about what could potentially happen in 2021, I think there are more optimistic scenarios than pessimistic ones. So I think on balance, the news is probably going to be good. The growth story is going to be more than good. I think it's going to be fantastic. And the GDP projections that we see for next year in both Canada and the US are north of 4 or 5%. That's an absolutely tremendous amount of growth from here to there. So if that actually materializes, I think the stock market is going to follow suit with the price action. So that's it, guys. Those are my thoughts for 2021. On the whole, I'm actually quite bullish. I'm excited that I'm now fully invested in the market. I'm looking forward to the gains that we're going to see next year. And more than anything else, I'm looking forward to seeing life return back to normal. And folks are going to get out there and keep spending, which I think is fantastic. So I hope you liked the video. If you did, please give it a thumbs up. Consider subscribing if you haven't already. Ring the bell, and I'll see you on the next one.